Barsha joins us now. Taher, what do you make of the market setup?
So, as I heard you say a little while back, market is kind of, uh, climbing the wall of worry. And I think, to some extent, uh, even for us, our expectations have been that, in the second half of the year, calendar year, we will probably see some bit of slowing down of the market, particularly given that there was a very important lineup of various events, both domestically as well as globally. Up until now, what we have seen is a couple of the domestic events, whether it is the elections or the budget having panned out, and market has, at some level, digested them reasonably well. I think, it has also been that, we've not really seen any great reason to immediately worry about the corporate earnings trajectory. And now, what therefore this has done is that market has kind of fortified itself in terms of its ability to forecast earnings visibility, not just for FY25, but perhaps even beyond that for FY26 as well, given that we have not really seen anything which is significantly disruptive. There have been some things which have not necessarily gone exactly the way we would have liked it to, especially as far as the budget is concerned. But nothing very dramatic to actually kind of change course. And I think that is the reason why obviously the market has held up. Like I've said on various occasions in the past as well, that, cutting across several of the events, eventually what will matter is whether we can keep to that 15% kind of expectation. I mean, just deliver on that 15% expectation on growth, earnings growth, which the market is kind of focused on, at least from an aggregate level. Um, and I think after some of these events, that is still kind of in the play. We have less to worry about at this stage. We are keeping some things in mind. For example, commodity prices. Can that be something which can probably, affect some of these numbers which are likely to come through? But even there, like we have seen some moderation in oil prices. Once again, metal prices, however, have also simultaneously come off after a decent surge in the last one or two quarters, one quarter or so. So I think there is less to worry about, and that is probably providing that confidence to the market to move a little more, move further ahead as we start discounting FY26.
They're not that great, right? I mean, this is data of what companies we've seen so far. So markets right now running ahead of earnings. How long will this sustain? For example, markets in last 1 year are up 25%. Earnings are growing at 14-15%. So how long will this sustain?
So again, there too, uh, like as you said, we've not really seen the whole of the earnings season, and but let's say if we were to probably just look at some of the two important sectors, which are reasonable heavyweights, banks as well as IT services, we are seeing other sectors also come through. But if you were to probably just look at these two, which are a little more homogeneous, I think we've seen some bit of under delivery and some bit of let's say modest disappointments as far as bank earnings are concerned, particularly from the point of view of either slower growth or maybe somewhat some rise in NPAs once again, or normalization of NPAs if we were to call it. But on the other hand, I think hopes have somewhat brightened as far as ability to accelerate earnings is concerned in IT services. There's been better commentary. There's been somewhat better delivery as well. So we'll see how they kind of square off or offset each other. In the meanwhile, I think some of the core sectors where growth has been visible and probably the expectations of the market are high is industrials and the whole manufacturing industrials related pack. And there we are seeing continuity of earnings growth, order flows, in even from the point of view of the budget. I think it has been supportive in general. So yet I don't think the fear factor is as much in terms of, like as I said, derailment of earnings or a significant detraction from that 14-15% odd number CAGR that we expect over the next 2 years. But we'll see. We'll have to take it quarter by quarter. As of now, some of these things are behaving quite well, and therefore market will kind of live up to it. We obviously have to. We don't have a choice but to keep looking at flows, which are also equally strong, both in the secondary market as well as in things like NFOs, etc. So I think that is something we may just extend multiples for up until the time at least visibility of earnings is not impaired.
Right. Tahir, since we're talking about earnings, I wanted to understand what you're making of FMCG so far. While it was an impressive set from both Unilever as Colgate, can't say the same about Nestle. But again, given the higher rural exposure that both Colgate as well as Unilever have, and the fact that both of them in their commentary have mentioned that rural is indeed seeing a recovery, do you anticipate that FMCG perhaps could be turning the corner now?
Yes, I've said so in the past as well, that this is a sector where relative value, if not absolute value, had started to emerge uh, a few months ago. And, we were looking for some of the things to fall into place, like, for example, the monsoon outcome, as well as in terms of, rural sentiments in general settling down and rural income stabilizing. I think that is starting to come through. Some of it is clearly a cyclical um recovery, so we have to treat it as such. And we'll have to see whether it transforms itself into something which is more meaningful. But up until now, we've seen a few good hits, some good hits, and a couple of misses as well in the FMCG space. But by and large, I think this is an area where we will see relative value. We will market will have to take cognizance of that, and some of it is also under-owned. I would like to assume. So to that extent, these may be stocks, or these may be sectors or parts of the market which can do relatively better. And then, we had started to see evidence of that. For example, two-wheelers was a starting point. I mean, we saw that 2 quarters back or 3 quarters back, when volumes in the two-wheeler space started to kind of move up. And generally, this has served as a reasonably decent indicator. I'm not therefore fully surprised that it is now starting to extend itself into some other categories as well. Consumer discretionary, at least durables, etc., also starting to see some vigor. So I would like to think that the case is clearly building up in this space.
Uh, Tahir, other than FMCG, where is it that you see the curve actually turning around? Could IT be it?
Yes, that's another area that we have been constructive upon, and you're right, Aisha, that this is another sector where we probably see relative value. As I mentioned a little while back, that we've seen better commentaries, we started to see some improvement, and more importantly, I think if you look at it from a global standpoint, this was a sector which was kind of bogged down by the rhetoric, especially as far as recession is concerned in the US. Much of 2023 was spent in speculating and debating about how intense would be the recession in the US, which, for one reason or the other, has not come to pass. And to that extent, I think that improves the prospects for this sector. I think it is a matter of time when commentaries also start to become a little more uh, uh, you know, positive compared to what it is today, and numbers are starting to show up. These are also sectors which generally are are easy to deal with from the point of view of balance sheet strength and general hygiene. So market only looks at delta earnings, and delta earnings, even if it is about 4-5%, is good enough to kind of create decent upsides in some of these in a good number of these names. And this is obviously a sector which spawns across large, mid, and perhaps even small caps. So I think this is a sector which will attract investors.
Um, Tahir, do you own PSU stocks? If you own PSU stocks, why? And if you don't own PSU stocks, why is that you don't own them?
So we have a fair bit of it, and I wouldn't know as to how we are relatively placed versus the rest of the street, but I think we have a fair bit of exposure. We continue to have it across some industrial names, defense names, obviously, because most of them are PSUs, and a few others as well, some even in the oil and gas space. So I think we have a fair share. We actually run a PSU fund, as you know, right? So we have a good number of companies that we look at it from a point of view of our PSU strategy. So I think we are uh, constructive. We are obviously bottom up even there, just as we are in the broader market or in the private space as such. So we apply the same yardsticks as what we apply for finding private sector growth or value oriented companies. And I think that's where they are. They are not no longer value as such as we have always known them to be, right? They are companies which are gradually transforming into growth entities, and we have to treat them once again at parity with how we treat growth companies in the private sector.
Tahir, this entire FI is selling. Why it is that we only find value in India, they are not finding value in India? भाई value तो
But
सब एक ही जगह
I
होती
don't
है
know.
ना?
More recent numbers are they supportive? I thought that the numbers have kind of improved in the recent time. But they have a multiple set of factors that they combine to actually look at allocating flows to a country, and it could be everything from what they see as the relative value in other countries, particularly as far as India is concerned. They square off quite a bit with China, of course, and then there are other things as well, relative valuations to some degree, and perhaps even commodity prices. Generally, uh, we've known to be high beta as far as commodity prices are concerned versus some of the other countries in the world. So I think that decides there. So like I said, so therefore there are multiple factors that they kind of look at an aggregate level to kind of decide flows. And of course, but I think interest rates, over a period of time with the narrowing of differential of interest rates between India and some of the developed countries is kind of putting us on a somewhat better footing, I would say, both from a stability of currency standpoint as well as from a relative return standpoint. So I would like to think that uh, uh, you know it, it it should be a matter of opportunities that are available to them, and I think they are participating. And nowadays, I see a lot of FI participation in the mid and small cap space as well, which was probably not the case some years back, and they would largely confine themselves to the frontline names. So I think the India story started to kind of rub off. I would like to think.
Indeed, there is definitely diversification and broadening of the market, and FIs as well participating in that. But Tahir, great to have you on the show. Thanks as always for taking the time out and speaking
Pleasure.
with us.